Hello guys, welcome back to another lovely trading video. In this one we're going to be doing the small account recap for the week and show kind of what trades we got into in the week, how the account's doing, and all of that. So firstly, you will have a screenshot on screen, but we will occasionally just flip it like that. You can see we are down £12.25 in total since we started the account. This kind of is what we expected, because going into, as you can see, I'll show you think I'll swim up. Literally, the majority of our large caps are down. Reason for that is obviously the overall market is pulling back. So if we go over to the S&P 500, if you've been trading at all this week, you would have known markets have been pulling back. We had a few days where the S&P 500 has closed down over 1%, which you don't really see that much. So in a time like this, you are going to expect to be down, especially if you're opening recent orders. But the only good thing about that is we are also depositing every week, so it's not like we're out of money now to not be able to get any more, but we are depositing for the next, I think, 3 weeks, £110 a week, then to £10 a week after that. So for the time being, it's actually a good thing that the market's pulling back, because we can start getting into trades we like the look of. We're getting better price. We're not going to be near all-time highs or anywhere near all-time highs, so we can start stacking up, start averaging down, get relatively good prices, and when markets do rebound, we will be in and be up hopefully quite a bit on each of our investment / kind of swing trades. And yeah, for right now, especially in this kind of market, we are going to be just doing more investments on this, because I think that's going to be the better goal of this, is just showing that you can grow these small accounts. So even if you're not starting with a lot of money, it is still able to make you quite good returns, even just a year's time. Even if we just do the challenge for a year, just to see where the account ends up in a year's time compared to initial investments. So yeah, to get straight into it, we can go over to activity. This will be thrown on screen, but if we go over to here, so yeah, first trade is Autodesk. That's the first one we took since depositing our money. So if we quickly go over to that stock, we can then see firstly, why did we take the trade? Reason for that is, you can see we had a large gap down. We'll take this over to a daily. We gapped down from 303 all the way down to where did we open up? We opened up at 262. So originally that was a 13.5% gap. And we knew on the day it most likely continued down. When the stock gaps that low, usually when markets open, it continues. Usually it's a sweet spot around 2-3%. If it gaps more than, say, 3%, usually it continues down for the rest of the day. Same with when the stocks gap up. If they gap more than 3%, they tend to usually close higher than that 3% at the end of the day. So when we saw this, we were quite close to at that time we were around the second deviation. So we let it sell off that bit more, wait for it to push down to a better price, and then we ended up getting it close down to much closer down to this 250 kind of area, which was roughly kind of where the third deviation was at the time. We can see now that the third deviations have fallen a little bit, but either way, if we're buying down in these ranges to second or third deviations and holding them more for investments, there's a very good chance that we will make a good amount of profit on this. For example, if we just look at the targets from, say, second deviation to statistical mean, which is where we look to get out the majority of profits, that is still about a 14% move, 14 to 15% move, and we may average down if it does fall further. So onto the next stock then. We then had Amex. I think it's AXP. Again, same thing. We're not going to be buying any more of these financial stocks. We do have quite a lot now. We have Amex, PayPal, I think we even have MasterCard, maybe even Visa. So we're not going to be buying any more of these, because we don't want to be too kind of finance heavy. And that's one thing on the account in the first week you would have seen in this, is we are quite tech and finance heavy. So coming into the next week, we will be going more for consumer staples, and kind of, if it looks more like a sector rotation is happening, especially when markets are pulling back, it doesn't make sense. It can make sense to be getting some more of defensive stocks and consumer staples, because they tend to still perform all right if markets are pulling back. But obviously we will be stacking up still on more tech, because that is one of the hardest hitting stocks when markets do pull back, because obviously they're growth stocks. So it only makes sense as well to be buying them when the market's crashing, because these are the ones that are going to crash the heaviest at the time being. And then they're also most likely going to outpace more defensive and value stocks when the market starts to rebound. But yeah, reason for American Express, as we can see, at least on the 4 hour, it's come down to a second deviation. It still has room to move on the daily, and that's why you'll see when we bought it, we only bought about £10 worth of it. We didn't want to get too heavy in because we already own the other ones like Visa and PayPal. And we were only on the second deviation on the 4 hour, hadn't quite hit it on the daily, so it doesn't make sense to be in as heavy when there's other stocks which are lower down on the deviation, so providing us better upside. But the reason we did want a bit of American Express is you can see the uptrend on these deviations are a lot stronger. Seeing that, it does make the opportunity a bit less risky. When you see the deviations in that trend, the trend you want to go, it just provides a bit more certainty that it will go that way. Now, beyond me, this is one that's actually gone down quite a lot since we've bought it, because we did buy it coming into this first deviation. Because we got that bounce, it did pull back, but it didn't quite bounce to that kind of even half deviation on the daily. We thought it would kind of push in, so we did get in that kind of bit early. Was a bit of an impatient play, but we weren't in with anything too massive. We got in with £15. So when it does continue down lower, because we expect it now probably will, it's something we will get a bit more of coming down into the kind of $50 level. If it bounces before then good, we won't average in anymore. But if it does come down to that around $50, $51 area, that's where we'll look to get on a bit more size. Now on to then Disney. Always forget the ticker for Disney for some reason. Let me quickly check then what the ticker for that is, because I'm not even exactly sure. Oh, is it DSI? DSY? No. Hopefully I do remember to edit this out, but if not, just excuse that. Okay, DIS, there we go. Okay, this one, again, this is one I always like the look of Disney. I mean, everyone knows the name. It's one of those stocks, I mean, it's been doing great for ages. I mean, if we go into a max time frame chart, you can say it is a stock since, well, IPO'd in 08, but has since continued up quite heavily, and it's a stock, I mean, more of a value stock, but does have some good growth side to it, especially since they've launched their next Netflix rival. But yeah, Disney came into the second deviation, so that's where we got some. Don't know if we're actually up on Disney or not. Let me have a quick look. Looking at Disney, no, we're down about 0.5%, because yeah, we would have bought around this second deviation, but it did push down lower. If it comes down to this 140 area, that's where we're getting a bit of size, because we only bought £5 of it. So yeah, if it pushes down further, that's where we'll look probably getting another £10-15, because it's one of those stocks we would definitely expect to bounce coming into that third deviation. Then the next buy, Gap. Oh, it's GPS, isn't it? Yep, for Gap. Again, we had that large gap down. We can see $23 down to, where was that gap down? 20% just on the day. Again, we would know it really pushed down that bit further. So as it came into the second deviation, that's where we ended up buying some shares. And how much did we put? We only put, again, £5 into it. This is a bit more of a risky play. It's not one of these massive, I mean, Gap is a name everyone knows, but not everyone really invested in it, so it's not something we want to be too heavy. And so, yeah, it's just one of these ones which provide a bit more risk. So as the market's pulling back, we can take some other alternatives. If the market wasn't really pulling back, then we would look for some more riskier plays such as this, where they provide the good upside. But as a lot of stocks, big names are providing good upside as well. Doesn't always make sense to be taking unnecessary risk. But now going on to one of the stocks where we are taking risks is SDC, and this is one we are down now quite a bit. I think we got the first small size, it was only maybe like £5 back at 370. Since then, all it's done is really pull back. And I do think if we come into this kind of 250 level, break through it, come back, retest 250 and continue down, that's when we'll just cut it as a loser. But we did kind of average in a tiny bit more size into there. Just because it's one of those trades where, yes, you do take on that risk. It is one of those stocks that does really just keep selling off. but it does provide good trading opportunities. I think I went through this in the previous one, and if we ever do analysis on it, one of those stocks that does fill these gaps, and it's when a pattern, when you see a pattern, they tend to repeat themselves. So with Smile Direct, we saw this gap, so we started getting in a bit of size after a few red days, hoping to catch that bounce of the gap fill of 523. We can see this is kind of the first time it's sold off this heavy, but it just kind of keeps continuing. So I'm thinking if it comes down to kind of 250 and breaks through there quite easily, it would just make sense to get out of this trade. It looks like we will probably match this pattern at some point, but it's kind of a when and where. I mean, we're not going to really try and time the market. If it comes down to then our deviation, then we'll look to get in. But if we don't really get that bounce around 250, it's probably when we're going to cut that trade. Next one, and you'll be able to see there's a random £1 deposit. It's because I was originally using Chase to top up the account. But in the UK, as it's not that big, I couldn't link it to free trade, so I had to end up switching it to a Lloyd's account, and that was just like the testing deposit. But anyway, now on to Johnson & Johnson. This is a big trade when I saw it. I always love Johnson & Johnson's trade. Not a massive name down over in the UK here. Still known, but nowhere near as big in the US. But either way, it's one of those stocks where if you can get it cheap, it's a great one to buy. I mean, if we go on to a max thing, I mean, I'll just leave it on max because it's quite good to see. I mean, again, kind of didn't even IPO, IPO'd back in 1985, and we can see from there, all it's done is grow. And it's just kind of one of those stocks where if you can get it at a discounted price, it's always a great thing to get. And looking at its all-time high of around 180, we are getting in, around 12% down from its all-time high. And if the government stops kind of tapering, or all this kind of news, we keep getting taper news. Obviously, when you see taper news, markets are going to drop because then bonds become more attractive, money comes out of the stocks. But I imagine it's more of an overreaction. Usually most things are on the market. We get the initial overreaction, and obviously we got the Omicron variant, which at the same time, so that's kind of due to the large sell-off. Usually especially the Omicron version is going to be an overreaction, so we would expect markets to bounce. And Johnson & Johnson, we could easily see it going to that all-time high this year. Wouldn't really be too surprised, or maybe not this year actually, so probably early next year, first quarter of next year is something I'd be looking for. Draftkings, we got into this originally in the previous one. It is falling a bit further. Haven't had this bounce. And this was one thing we did see what was quite weird on DKG, is nearly 99% of the time, it's not a real statistic, but nearly all the time. I mean, if you've been watching me for the past year, we go through each of these stocks. We always see bounce coming into deviations. This was kind of the first time we didn't see a bounce, and it was quite strange to see on DKG. Came into that first deviation, we didn't really get any sort of bounce, not even a small one to a half deviation. We just didn't really get anything. It just continued to power down. So it's something where we are now down a bit on it. Looked at it in a tiny bit more size, and that's what we did kind of coming into the 28. And we'll probably leave it alone unless it comes down to the third deviation, and we will get in some more size. But yeah, we're not really going to be getting in too much size with it, just because as well you have big investor names out there who are saying, keep mentioning Draftkings, along with another stock I can't remember off the top of my head. Draftkings was one of the ones mentioned that was just saying it was very overvalued. So if we can get more down at $20, we will definitely average down a bit and look to lock in profits on this kind of one, say around $35, or just wherever the first deviation is when it comes into the time. The reason we're not going to hold this one to statistical mean is just all the big names kind of talking about it right now. We are seeing ARK Invest, Kathy Wood buying more of Draftkings, but it's not going to be taking too much credibility from her right now, as obviously the majority of her portfolio is down, but that's just because she's very tech heavy. And then the last stock we then bought was SE, which is C Limited. C Limited. And this one again putting back quite heavy. One of those big names. You can rely on it. It's a blue chip kind of stock. You can see again strong growth. This is probably it is its largest pullback. Don't really see it dropping below kind of that $200. Obviously that is a far way away from now, so for the time being We bought some coming into this second deviation because that's where we consider it a low risk buy. So we got in with $20, something we would look to average in. If it comes down to $220 and $200, we will definitely be getting more size on this stock. But I mean, I could see it coming down to the 220, 223 area. But the $200 I think is a bit of an overreaction. Unless markets do continue selling off, then really nothing is impossible. But those are all the trades for this week that we've taken. You'll see we aren't really just taking a few, maybe like 3 or 4 with large size. I'm thinking it's a better idea, just kind of have them diversified out. And especially in this market where so many things are pulling back, coming into alerts. I mean, if you're in the Discord, you would have seen how many alerts we were sending through. When you have so many alerts going off, it can make sense just to get in a few different names. Like even just when we have PayPal, Visa, American Express, they're more likely than not going to move the same. But if they all came into the same level, we can diversify them out. And then let's say if one of them has good news, then obviously we'll make the gains on that diversified portfolio of it. But then obviously if one of them has bad news, then they're not all going to get damaged the same. It's kind of just a way to diversify. And then we're just going to we can be in a lot of different sectors. We don't have to be too, let's say, tech or finance heavy. We can start averaging out, so we can kind of see tech and finance we are the heaviest in, and then coming consumer goods, telecom, health, entertainment, they're kind of all around the same. So they're probably going to be more ones we'll look to get in a bit more size coming into next week. One though we are looking to get into next week will probably be Facebook. It has pulled back quite heavy. It's coming into the second and third deviations now. This is one we are probably going to get in quite heavy coming into next week. So yeah, we deposited £110. Probably looking to get into this one with probably £40-50 of the weekly deposit. Facebook is one of those ones that I always like, and we're always getting a bit heavier. So hope you enjoyed the video, hope to see you in the next one, and that's it. Peace.